We have officially entered a new phase, an era where geopolitics is no longer background noise, it is the primary driver of markets. If anyone needed confirmation, the past week delivered it in full force. Renewed tensions between the United States and Iran, a legal battle over tariffs, questions about institutional authority, oil moving higher, inflation pressures lingering, and equity markets that, on the surface, look calm, but underneath are rotating aggressively. This is not a normal macro cycle, this is a geopolitical regime. Let's start with the tariff situation. A major legal ruling challenged the validity of previously imposed tariffs. Now, regardless of where you stand politically, the market is not debating ideology. The market is asking one question. What does this mean for credibility? Because if tariffs that generated roughly $175 billion in revenue are suddenly deemed invalid, the immediate follow-up question becomes obvious. Does that money have to be refunded? Is the government exposed to repayment risk? So far, the market's answer appears to be unlikely in the near term. And you can see that in the bond market. The U.S. 10-year yield has remained within a tight compression zone around the 4% level. That level is critical. A decisive break lower would signal recession fears. A decisive break higher would signal fiscal stress. Instead, bonds barely reacted. That tells you something important. The bond market, the true guardian of fiscal discipline, does not yet see an immediate balance sheet shock. But here's the key distinction. Even if the fiscal impact is limited, the reputational impact may not be. When trade policy becomes legally contested at the highest level, when executive decisions are publicly challenged, global capital takes notice. Because global capital values one thing above all else, predictability. And when predictability weakens, diversification accelerates. This is where what I call the basement trade comes in. The basement trade is what money does when it doesn't want to argue politics. It quietly moves into assets that do not depend on institutional promises. Gold, silver, copper, energy, hard assets. Over the past week, we've seen a noticeable rebound across several of these components. Precious metals firmed up, industrial metals gained strength, energy remained supported. This isn't speculative euphoria. It's hedging against credibility risk. Zoom out further, and you'll see another structural trend. The US dollar's share of global reserves has been gradually declining over time. This does not mean the dollar is collapsing. It means marginal buyers are diversifying. And every episode of policy uncertainty reinforces that instinct. Now add the second geopolitical layer: Iran. Tensions around the Strait of Hormuz are not just regional political issues, they are supply chain pressure points. Even without a direct conflict, rising probability of escalation creates an oil risk premium. Oil has been climbing steadily since the start of the year, and oil matters for one reason above all: inflation. If energy prices continue rising, inflation becomes stickier. If inflation remains sticky, the Federal Reserve has less flexibility to cut rates. And if the Fed cannot ease as aggressively as markets expect, financial conditions remain tighter for longer. This is how you quietly slide toward a stagflation-light scenario. Slower growth, persistent inflation, higher for longer rates. And it's not a coincidence that the stagflation trade has been one of the strongest performers over the past month. While headlines focus on AI, capital expenditures, and tech narratives, capital is also positioning defensively beneath the surface. Now let's talk about the equity market structure. Some of the so-called Magnificent Seven have experienced significant drawdowns, in certain cases more than 20% from recent highs. Technically, that qualifies as bear market territory for individual names. And yet the S&P 500 remains near its highs. Why? Because capital is rotating. Money is flowing out of mega-cap growth and into cyclicals, value names, industrials, and energy. This rotation masks the correction, but it does not eliminate it. The question becomes, how long can rotation sustain the index if the former leaders remain under pressure? And there's another area quietly flashing signals: private equity. Some companies heavily involved in financing data center expansion and AI infrastructure, particularly those exposed to shadow debt structures, have seen sharp declines. When liquidity tightens, leverage-sensitive vehicles feel it first. They often act as the canary in the coal mine. Put all of this together: legal uncertainty around tariffs, questions about institutional credibility, a gradual shift in global reserve composition, oil rising on geopolitical risk, stagflation trade outperforming, mega-cap leaders correcting beneath the surface, private equity under stress. This is not a panic market. This is a transitional market. And transitional markets are dangerous not because they crash overnight, but because investors misread the regime shift. We are no longer in a purely liquidity-driven environment. We are in an era where geopolitics, credibility, and power dynamics are central inputs into asset pricing. When geopolitics becomes structural rather than episodic, portfolios must adapt. The key question now is not whether volatility increases. The key question is which regime ultimately takes control. Recession, stagflation, dollar weakness, commodity strength? Because in an era of geopolitical dominance, the winners are rarely those who react emotionally. They are the ones who recognize that the rules of the game have shifted and position accordingly. Let me know in the comments. Which trade do you think benefits most from this environment? Recession trade, basement trade, Goldilocks trade, stagflation trade? I read every comment. Because in a geopolitical regime, sentiment is as important as data. See you in the next deep dive.